delighted to be able to branch out into this new area. During some of the coffee breaks and the sessions yesterday, I had a number of people expressing surprise to me that we were actually going to do a panel on the meaning of life. I hope that's because they were P&C people and just didn't appreciate the contribution that the life sector makes, as opposed to thinking that we were going to have too much of a philosophical debate this morning. But with the brain power that we have assembled here, I think we can probably cover either. So no, I'm looking forward to the discussion. I think it may hint on the fact that people don't often think of Bermuda as a life insurance or life reinsurance center. And the sector itself probably doesn't do a great job of articulating how much value and activity really goes on here and why it's an important part of the world life reinsurance markets. I think people are often surprised to hear, just from a pure volume perspective, how significant the life business is in a Bermuda marketplace, and makes up approximately 1/3 of the total Bermuda marketplace, depending on whether you're measuring by either assets or premiums. So I think that statistic often surprises people in the context of the companies typically being lower profile. So with our session this morning, we're hoping to debunk some of that and give you a good spread of kind of knowledge from each of the kind of sectors of the industry, be that the kind of primary business, some of the longevity perspectives, and also the focus on spread business. I think we've got a great panel to help work through some of those issues. So to my immediate left is John Coughlin. John is the CEO of Safe Harbor Re, having previously worked on a number of kind of startup life reinsurance entities here in Bermuda, so very familiar with that model, and in particular with spread business. To John's left is Craig Fowler. Craig is the SVP for overseas reinsurance with Aegon, and responsible for the kind of Transamerica captives that are in place in Bermuda. Craig also has a prominent role on BILTER, the Bermuda International Long-Term Insurers and Reinsurers Trade Industry Association, so an equivalent of the ABER grouping. And then to Craig's left is Casper Young. Casper is the Managing Director of Origin Reinsurance in Bermuda and has overall responsibility for Origin Group Services, and is also closely involved and was one of the founding members of the BILTER grouping. So by way of introduction, just to get things moving, guys, I kind of commented about the size of the overall life market in Bermuda and how it's one of the areas where we're seeing some organic growth. And that's coming in both the form of new entrants to the market, but also existing companies increasing some of their books of business. What do you see as being the drivers for this growth, and is it sustainable? And John, maybe if you could lead us off.
Thank you, Colin. I would say that, it is encouraging. I think there's some new entrants into Bermuda, the life side, organic growth, which is unusual, and all the discussion on the property casualty side about ILS and third-party capital. Here we're seeing conventional companies started from scratch. I think a lot of that is just solutions that are being deployed to the U.S. primary life insurance market, which right now, due to low spread environment, years of low spread environment, really is crying out for just capital relief and other aspects of, I think solutions, again, that the unique aspect the Bermuda market can provide to both the U.S. and the EU, primary companies.
Okay, and I think some other aspects of what's helping to drive the growth in Bermuda on the life side, in addition to what some of the items John mentioned, I think just the regulatory environment here has done a good job moving and advancing to enhance the credibility of Bermuda as a regulatory environment. And as we're seeing coming out of the financial crisis, and also now with some of the regulatory challenges in the U.S. market, and also what's going on over in Europe with Solvency II, that credibility and being viewed as a real regulator is valuable to companies who are ceding. BMA is still maintaining a good sort of balance, being pragmatic and working with the companies, but that enhanced regulatory environment and hopefully being deemed a qualified jurisdiction by the NAIC in the coming months is is quite valuable to many companies, I'm sure.
And I'd like to add, I mean, a lot of people use Bermuda now to aggregate their balance sheets. So, you know, it's a great place for kind of capital aggregation, but it's also a great place for human capital. And I think one of the things I'm seeing over the last few years is as more long-term companies come to Bermuda, there is a greater, you know, group of people who have the skill sets and the consultants who can help. And I think that's a real attraction to why Bermuda's going to, you know, continue this on this path.
On the other side of the coin, we're obviously seeing a number of challenges that the industry is facing, and I think one that came up a lot on the P&C side as we were listening to it, and certainly historically people would imagine that it's even more relevant on the life side, is the low interest rate environment. And with the ECB action last week talking, I think as Arthur's panel mentioned earlier, practically zero interest rates. Despite that happening on the investment side, policyholder expectations are continuing to rise, and they constantly seem to want more for less. How does the industry manage to design products that are going to be attractive in the marketplace but still offer a fair return for the insurers? Craig, maybe if you could lead off on this one.
Okay. And I'd say definitely the low rate environment is very challenging. I think companies have done sort of a good job bringing product guarantees down as low as they can, but going forward it is challenging. It seems like the industry is getting a better handle on what the options are that they're giving out and what the value of those are. And I think once you have that sort of a framework and that thinking, you can then develop something for clients where they can still have some sort of a minimum rate or minimum guarantee, which demographically and societally people are screaming for, but then maybe they trade some of that off for the upside, and they don't get all of the upside in, say, an equity market. And you can therefore hopefully develop products that are valuable to the clients, valuable to the policyholders, but are not so risky and so expensive to the life companies that, you know, when that inevitable happens, they're not bailing out or having to go get more capital. So I think it's important that the industry is getting a better framework for looking at some of the optionality and then going out to the clients and working with them and offering up things that still give them enough security, but maybe not as much upside as they may have wanted, or maybe there's some triggers within the product that help make sure that you know, if volatility increases quite a bit, the product is not as risky to the life company, but still valuable to the client.
I would add that, just picking up on something Casper said, that Bermuda as a jurisdiction, just the innovation that is here that is primarily been driven by the property casualty side of the business is now being applied to the quote life side of the business, which encompasses, you know, primary companies, longevity, mortality, and also the spread business. And that's very important as far as getting back to product design for offering solutions to really underserved in the, you know, getting close to the retirement market, people whose the low interest rate environment over years, which has been driven by the, you know, the Fed and other, you know, major banks, has been great for housing market kick-starting, you know, the economy allegedly, and then, but terrible for retirement products. So finding innovation, working with customers, resetting policies from, you know, fixed guarantees to index guarantees, being able to carry and take advantage of the hopeful, you know, upswing in interest rates, all that's important. And, you know, new product design, I think the industry is responding positively to that. Interestingly, I think we just saw a statistic where 11 of the top 12 annuity products, fixed index annuity products, are now written by primary companies that are connected to reinsurers. Either Bermuda reinsurers or US reinsurers, some with Bermuda operations. So the leverage of using reinsurance, using the Bermuda jurisdiction, developing products and solutions for, you know, this increasing, you know, hockey stick curve of retirees coming online is really fundamental.
Yeah, yeah.
And I think, like many of the P&C companies, there's a variety of underwriting or way you make money, either on the asset side or the liability side. And the company I'm at, we're not in the spread business where we make the money on the underwriting of the biometric risk. So low interest rates are challenging, but we don't rely on the asset side of the balance sheet to make the money. So.
I think that's an interesting analogy, Cass, between some of what we were hearing, particularly on the chairman's session this morning, of the difference between, say, a third point strategy and a valid strategy in terms of where they're looking to take that risk onto their balance sheets, and we have some of the same parallels in the life market. Just kind of building on the point around the investment strategies, what differences are you seeing from the traditional investment strategies to respond to some of the policyholder expectations and the pressure to generate additional returns? And maybe John's question of, well, what's driving those top MAGAs to be supported by some non-traditional forms of capital?
Right. Well, as Craig said, I mean, the fundamental issue in the industry is in the life insurance industry, in the asset business, annuities, et cetera, is low interest rates. So getting to some sort of increased yield within regulatory and capital constraints, investment guidelines is very difficult. So you really have to thread that needle to try to get to both an acceptable return for shareholders and policyholders. So finding access to new asset classes, maybe possibly more liquid going longer term, or also being able to balance your portfolio, you need some liquidity to take advantage of hopefully rising interest rates. Looking at bank loans, for example, which is the major asset class that insurers are looking at. So I think those are some of the solutions that are being offered right now.
And Craig, on the primary side, are you seeing different investment strategies, or taking a closer look at how?
Yeah, I think there's always been this trend, and you're trying to look at some of the new asset classes, CLOs, bank loans, like John mentioned. The primary industry, the primary insurers don't tend to gravitate too much from the average, which does present some challenges, but you're seeing people where they think they have a competitive advantage, where they're willing to do more of that. I think you're also seeing a little bit more derivatives overlay type strategies where you may be able to buy and sell various options a little bit more cheaply on the fixed income side with say, vol being low. So I think you're seeing companies extend into some of those pieces. Hopefully it's not setting up for 2007, 2008 when a lot of structured assets had a lot of challenges, but you presume you're doing it in an appropriate way and getting paid for the risk you're taking. So.
And once again, I'll be slightly different again. In the underwriting side, we make our money, but in terms of the assets, we actually spend a lot of time on asset liability management. And people talk about being short or long. Sometimes when we structure our assets, we're out 20-year durations. And so we spend most of our time not necessarily on asset selection, but it's usually conservative, but more on the duration of convexity to make sure it lines up with our liability profile, which is a slightly different game, where we actually we don't have in-source investment professionals. We actually outsource it all, and we spend most of our time on the analytics around the cash flows.
And I guess it's getting that asset liability management part that's critical to your part of the business, because in a low interest rate environment where if interest rates were to pop up, if you haven't got that matching right, then... And
you have such a long tail and such long leverage that we have to do that right. So our volatility is very low, and it goes back to the biometric risk.
Yeah. Another cloud that we're seeing with a possible silver lining is the regulatory environment. And regulators in the U.S. market, and I think particularly in New York, have been taking a keen interest in the life sector. And there's been considerable debate around the appropriate levels of capital for life insurers. Do you feel, and Craig, maybe you could kick off with this one, but is this creating more of a threat or an opportunity for Bermuda reinsurers?
I would say it's a shorter term threat. Not quite sure where New York NAIC comes out. There's been some pronouncements around some of the acquisitions made in the marketplace. New York has gotten the press they wanted by being able to stated that they were able to add some additional layers of control and support for some things. But I think longer term, it's actually probably an opportunity. Again, with what the BMA has been doing, the regulatory environment, this isn't a jurisdiction where you just reinsure business in and hold no capital against it. I think that's been some of the concerns from the regulators and from some of the rating agencies as well with different jurisdictions. And so I think over time it actually ends up being more of an opportunity as Bermuda is recognized as again, as a credible regulatory regime.
Yeah. Casper?
I think in the short term, I agree. I mean, regulatory change is risk. If you turn the clock back 3 years in Bermuda, 4 years in Bermuda, when you know, the long-term regulatory regime kicked into high gear, I think if you talked to anyone at the table in Bermuda at the time, and you said, "Well, your top 3 risks," you'd say, you know, interest rates and underwriting and regulation, and then you'd say, okay, out of the 3, which can you control? And you can control a certain extent in the first 2, but the last one, regulation, you can't control. And I think all of us, when we went to our risk committees, you know, we all had very awkward questions around what's happening to change in regulation. Now, luckily, you know, I think the industry's worked very hard. The BMA's worked very hard. I think we've come to a good spot. But when we look around the world, and NIC is a great example, and we see regulatory change, I think my natural reaction is to be, geez, that's risky. That, you know, what don't I know? What can't I control? But I think as globally we move towards hopefully, you know, a more common regulatory framework, I think that's good for everyone. Where, you know, people don't necessarily worry about, you know, regulatory arbitrage, who worry about having the right amount of capital. I think that's what the discussion should be. But we're going to have these examples come up, and I think we're all pretty sensitized to it.
So you don't see it necessarily creating additional demand for reinsurance in and of the fact that some of those states may be looking to apply different capital standards. And I know one of the things we've talked about is New York's difficulty with the principles-based reserving and trying to apply a much more formulaic and, from their perspective, tried and trusted approach to how they're looking at the business.
Will it generate more reinsurance demand? Maybe, maybe not. It's hard to say, and every situation is different. But I think in some cases it does. I think in some cases it's sensible that you know, it may drive risk towards risk pools like Bermuda. In other cases, it may keep it in smaller concentrations, which probably isn't good.
Yeah.
Well, I think it's some of the increased regulatory scrutiny is around the buyers of, you know, companies. So the consolidation on the life side, which is, I think there's been about, in 2013, maybe 150 billion of assets changing, reserves changing hand in the U.S. life market with Aviva, Sun Life, you know, and some of the others as well, Hartford, et cetera. So the buyers of those, which are not natural buyers, they're not like in the old days, MetLife, if it was a company struggling, if there was acquisition, you have a big MetLife where the regulator would just push the, you know, a company into, you know, a large MetLife. These days, it's really the alternative capital, which is a big issue in our space as well, a little bit different issues than on the property casualty side. But so it's the new buyers that are coming in that are really, you know, shaking things up a little bit, and that's, I think, what the, you know, in particular New York regulators are sensitive to. And although it's hard to say how many people are on board, you know, other regulators are on board with New York, their particular approach to things. But that's, I think, is one of the key driving fundamentals now is new capital coming into the business. And also the issue of low interest rates are driving certain life companies out of the business.
Yeah.
So you do have, I mean, you have the Canadian companies that left, like Manulife and Hancock, and then the European companies like Aviva that have also exited. But you also have a big U.S. Primary life population where there may be combined companies of both property casualty and life business, where they're just not focused on the life insurance business and the asset intensive business, which really takes a commitment on a variety of different levels.
Yeah.
So you're seeing this really massive sea change, a big new dynamic, you know, in the life markets, which I think should help. At least I think we all believe that from the reinsurance standpoint, offshore reinsurance standpoint, we have flexibility in design, in a direct relationship with the regulators who are both, you know, long-standing, great reputation, also, you know, commercially, you know, reasonable as far as the jurisdiction. So all of that, I think, portends for, you know, significant change in the next few years, especially as interest rates remain low, and it takes a while anyway as they rise to, you know, import them into your bond portfolio.
Yeah, yeah. And Craig, just picking up on something you said about the concessions that New York has kind of managed to secure on some of the transaction activity that we've seen. I think our perspective when we've considered some of those, that it's typically been a pretty small piece of an overall transaction, yet it commands a vastly disproportionate amount of the press and media coverage with respect to the impact on being able to close particular deals. Do you think there's a likelihood that as other regulators see the concessions New York has been able to gain, that they may be following suit when they're considering acquisitions in their own states, and that it may have somewhat of an anchor effect on the ability to get deals done, or you see it more as being an issue particular to New York?
I'd probably lean it more towards an issue particular to New York. You could definitely see some other regulators copying the concessions. As you said, they haven't been, in the grand scheme of things, overly material. They've been good press, but they haven't been overly material. But at the end of the day, and until it changes, the U.S. is regulated by the individual states, and they tend to have their own opinions, and they tend to be fairly steadfast in what they're doing. New York definitely influences things, but I don't think you necessarily see it cascading out everywhere into consistent across all regulators.
Casper, John, and
Let's hope we don't see it going across all regulators.
It's a different way to answer it.
Yeah. Well, I mean, once again, the risk from Bermuda is regulatory conflict. I mean, we're sitting here taking risk from the Americas and Europe and Asia, and the extent to which the regulators don't see things the same way. I mean, that's our big risk. That everyone says, I control the risk coming out of my jurisdiction. That's what I worry about, and the extent to which Bermuda does have a good reputation, I think that really helps. And seeing some of the concessions, maybe that's good for the press. It's not that large. I think that's fine.
Yeah, so I would have just added that the question is, how much is smoke and how much is fire? And ultimately, those transactions were approved, and it wasn't. I mean, there were, I guess, they were somewhat significant material, redundant reserves or whatnot, but still they were approved, and so people want those. I mean, ultimately, the regulators, their primary concern is effectively the policyholder, and is this good for policyholders? And so that's an interesting question. So as opposed to the buyers being a negative, in fact they might be a positive, and they're certainly the only buyers out there right now. So looking at that is, so I would concur that I think it's you need to work with the regulators, get them up to speed, and I think there's more of this coming, more of the M&A activity in the U.S. So they'll certainly be well versed. New York's a particular jurisdiction. Most companies have a separate New York company because of that effect. And so the concessions really are on the New York companies, not on the overall, global transaction, which is important to understand.
Yeah, but it's probably a case New York is too big to leave out of a larger.
Well, it's a well-known jurisdiction, lots of press, and also lots of talented people in the department. So, it's certainly a regulator that you want to tread carefully with, and be on a friendly basis.
Well, speaking of being on a friendly basis with regulators, I think we've spoken a little already about how well Bermuda is positioned with its regulatory environment to react to some of these opportunities, and it's clearly been an area when we look at the BMA's activities where there's been an increased level of focus on the long-term sector and the development of the long-term BSCR in the last couple of years, and really responding to the fact that previously the existing capital regime, which was kind of baseline of 250,000, wasn't really reflective of the risks that the sector was presenting. So we've seen a lot of work from that, and I think you've commented on some of this already, but Craig, maybe you could lead off with some of the activities that Bilter have been involved with respect to the BMA, and how well you see that translating in terms of the competitiveness of Bermuda as a jurisdiction, and kind of what the next steps might be.
Okay. And I'll sort of start building from one of the things Casper mentioned about sort of three and a half years ago, as the BMA started to try to bring in a more robust regime for the life companies. there was a lot of fear in the industry, and yet we weren't very well organized as far as an industry. It still was very much individual company going into the regulator. There was a few of us, 5 of us, that were trying to coordinate our efforts and speak to the BMA, but even at that, we weren't really getting the audience with the BMA. It was sort of, okay, that's nice, we're going to have to listen to everybody and kind of work through it all. So we formed Bilter middle of 2011, and I think it's worked out very effectively in a lot of ways. We've had a lot of discussions with the BMA on some of the regulatory and group solvency aspects and how that impacts the different companies here. We've had a lot of discussions on the BSCR, as you mentioned, both required capital and collateral and for encumbering capital. We've had discussions around some of the reserving bases and things like that. And as well, we also have another group that Bilter works on that's more tax focused. And so for things like FATCA and other aspects tax related, we've coordinated more with the BMA, and I think it's gone relatively well. It's the BMA, I think, has been happy because we're trying to bring the voice of the industry. So it much less, but still some one-off kind of conversations with individual companies. But we're trying to bring more of an industry voice, and BMA has been great to work with on some of that. At the end of the day, they are the regulator, they have the final say, and you're not going to get everything you ask for, but I think the most you can really expect is, if you can get an audience and have the conversation, you can try to rationalize through things and present hopefully well thought out arguments. So I think that's the efforts of Bilter and the efforts from the BMA have been very helpful in making sure that it's a robust regime, but we're not unintentionally chasing away business from Bermuda. So.
Casper, anything to add from the kind of Bilter perspective in your involvement?
Yeah, I think when you look back and you look at the principle that we want to come up with the BSCR, that will help calculate, are you solvent, how's your reserving. I think one of the biggest challenges, and one of the things we did when we first started Bilter was there was a survey of all the companies, and I think the firm conclusion of the survey was that all the companies are very different. And so trying to build a one model, simple model that captures risk adequately for a wide variety, not necessarily homogeneous group of companies, is a tough thing to do. And so I think, I think the industry's done a good job. I think the BMA is being quite sympathetic to the fact that we do have a number of product lines and business models and structures that trying to model it in one place is next to impossible. I think it gives you a sense of what's going on, and I think intelligent regulation is really the key to looking at the figures, looking at the standard model, and figuring out what the adjustments are. So, and that's not to say that we're done. I think this is kind of an evolving process where on the margin, I think every single company out here is going to say, geez, I like it, but this works, but. And as long as Bermuda and other regulators kind of are flexible to the unique needs of companies, I think that's key. And I think it's happening.
I would just make a comment for the audience that Solvency II equivalency is really how Bilter was really, that was I think the moment it was founded was around the equivalency and getting some opinion in there and working with the BMA and helping to define that. But the solvency issues for our industry, with very long tail industry, so we can have, it's unusual, the prop cat, annual renewable, et cetera. Our liabilities are 5, 10, 15, 20, 30-year liabilities. So the solvency issues are critical, right out of the gate. And so that really differentiates us, long tail business, from the shorter tail, some of the urgency around those solvency to the BSCR, the reserve requirements, et cetera, really important.
Yeah, and I think some of what we've observed with respect to the analysis that was done of the existing Bermuda marketplace, although, as was highlighted, it highlight a lot of differences between the companies, it did also pull together that the majority of the business was North American based, and that therefore the attractiveness or the relevance of the Solvency II framework back when the discussions were kind of being kicked off around the 2008 time wasn't as immediately apparent as it was on the P&C side. And I think there's been kind of good dialogue in terms of improving the regulatory environment so it's fit for purpose and it's a Bermuda-based model as opposed to trying to be a Solvency II-based model. And I think that in and of itself is probably highlighting some good forethought by the BMA, because we look at where Solvency II in Europe is at the moment, it's essentially being held up because the Germans aren't comfortable with the impact on the life insurance industry. And that's likely to extend the timetable further. So I think the pause that was taken there was an important one, and making sure that what's introduced here is fit for purpose. But I think one of the challenges that diversity in the companies that we have here, and it was already mentioned, is that it's hard to find a one-size-fits-all model, and from a regulatory standpoint, and I think that's part of the reason why the BMA is gravitating towards use of allowing companies to use their own economic capital models. But certainly when we reflect and kind of as PwC looking across the global insurance industry context, we're seeing large divergences between regulatory capital models, rating agency models, and the company's own models. So if I could ask the question, how good a job do you think the industry is doing of being able to articulate and calculate its own economic capital needs? And then any perspectives you may have on why there's such an apparent disconnect on this key question of how much is enough?
Let me, as the non-actuary, let me just give a common man answer on this one. But most of our business is North American. So the regulatory requirements, risk-based capital, which is what the U.S. companies hold, you're going to, regardless of our economic capital models, we'll hold the amount of capital that the cedents, our customers, are comfortable with. So they're going to drive that discussion. They won't drive our models, but they certainly will drive, the surplus in the transaction. And then if you're a, captive companies, et cetera, rating agencies have a big impact on how much capital you're carrying. So the Solvency II equivalency, which is great for the jurisdiction, all the other NAIC requirements, et cetera. In the spread business, there's a lot of investment constraints around what we can and cannot invest in admitted assets, we're offshore, et cetera. But a lot of it's going to be, commercially driven as far as what's acceptable, that trumps any of the, the formulaic or regulatory requirements.
Yeah, I mean, I would agree with that. I mean, when we run our models from internal economic capital models to various jurisdictions solvency, we do get pretty significantly different numbers. And we also run, embedded value numbers. And so you end up having multiple views on same cash flows, which, in the end, you have to make decisions. And in the end, it's the customer-driven, decisions that kind of take the day. Obviously, you have to, make sure all the stakeholders are happy. But so it's not really any one model, and any one model, depending on what basis, and also what you're using, Canadian GAAP, US GAAP, some other GAAP, IFRS. I mean, so it's an interesting time to have all these multiple views, and no one answer is usually right.
Do you feel the industry has a marketing issue and that it kind of can't get people around the one truth?
The industry has struggled for decades and continues to struggle with explaining the industry and where the profitability is. Yeah. And coming back to what John said, and Casper and I are these, but some of it's just the actuaries.
Yeah.
Get all these
two actuaries in the room, and how many opinions?
Yeah. You get these models, and they all sound really good, and they're really good overall, and they're nice and technically sound, but they're not really, built for the business. So. You look at some of the stuff that's going on in some of the discussions globally, and you've got a long-term liability that's incredibly illiquid, no one can get out of it, and you're fully marking the asset and introducing a tremendous amount of volatility. I think it's important that we build up reserving and capital regimes that encourage the right kind of ALM, like Casper was saying before. That's something the industry hasn't done as well in the past. But to look at something and say you need to liquidate all the assets within the next 6 or 12 months on a 30, 50-year product that someone can't surrender, you're just introducing noise and you're just confusing people. So I think there is a market, you look at the multiples of the life industry versus the banks and others, and it's always, give or take half of what the banks are at. Are we taking more risk than the banks? Probably not. But it just isn't explained very well. So.
And I think that's something that was consistent with some work PwC did a number of years ago, looking particularly at the reinsurance sector and how well they were able to articulate shareholder value propositions. And I think it's been a recurring theme at this conference and others over the past number of years in terms of how to be able to demonstrate the value so that you don't find insurance companies trading at discounts to book when other industries are able to get multiples. Kind of just moving into maybe the impact of some of those issues and thinking about M&A activity and industry consolidation and some of the new entrants that we've been seeing coming in. We've seen a number of large acquisitions, and John, you mentioned the kind of size of activity that we've seen in 2013. But even prior to that, we've seen some good volume, be that in either the primary market or large block trades.
Well, again, in North America, which is where most of the business is headquartered, I do think that, there's third-party capital coming into our industry. So it's it could be hedge fund capital, it could be private equity capital. Bermuda is, sexy again as far as an alternative asset class from a variety of different viewpoints. And we are, as the first-time life panel, we're kind of the poor sister here, but we do get a few meetings, on the way to the airport when people are looking at Bermuda business models. And I think I actually think that the life industry itself, with, again, sustained low interest rates, there was a real push in the 80s to sort of crossover businesses. And there's been multiple times over there's a cycle of property casualty companies going to the life business and life companies going to the property casualty business. It's two different industries. So I think people have finally, at least for now, figured that out, and that issue seems to be settled. But as far as U.S. life consolidation, the issues we've seen from the top down, the Hartfords, the Allstates, the big companies, for a variety of different reasons, but ultimately I think the same thesis of focusing on core industries, their core industry, which is property casualty, and really exiting the life business, which really takes a huge commitment. In the life business now, you have, most life companies don't have internal distribution forces. You have this big third leg on the stool with primary and reinsurance companies of distributors that sell these products to the consumer. Pardon me. And they are a very powerful organization. They can sell, a heck of a lot of product in a very short time if you give them the right commissions and the right, product guarantees. So what you'll find, I think, is further consolidation as it filters down in the industry where people decide that, and as you said, the life business is really just a drag on ROE because if you don't have a large enough company with a big enough asset base, you're not going to get to, some of the big companies have obviously very sophisticated asset managers, hundreds of billions of dollars, can get to all sorts of asset classes, but the access to those may be shut off, and you're really looking at what is our core business and how do we increase our ROE and, make returns attractive to shareholders. So alternative capital are looking for those opportunities right now. Investment bankers have been very successful. They've sold Sun Life $30 billion. Sold Aviva, $65 billion, sold the Hartford, dismantling the Hartford life side bit by bit. So I see a lot of, in theory, there should be more consolidation coming along, more divestitures, people exiting the business. Some of those exits are going to be through reinsurance. Yeah. That's how you will sell the business because you can't untangle, the reserves and the accounting, et cetera, from the mothership. So I think it bodes very well for us and other folks in our industry. It's a very sophisticated group of people. There's been a crossover, particularly on the actuarial side with CFAs and capital markets people coming into the business. Someone else on another panel mentioned the talent that's come into the industry itself. So I think it's, we're honing in on more efficiency, and that means more opportunity.
Casper?
Well, yeah, I'll echo that, on the North American life reinsurance side, there's been a lot of consolidation. I'm not sure who's left, actually. And you're seeing actually possibly a pushback on concentration of risk, where some of the larger life reinsurers are taking a large part of the market. And That's an interesting concept that, you can only consolidate so much until the retail guys go, geez, I'm not sure I like placing all my business over here. And certainly at Origin, our thesis is that smaller life re companies do have a place. There is an inflection going on, and new, fresh capacity. Actually, there is opportunity for us there. And I think also with the third-party capital coming in, there's great things to look forward to in the U.S. and North American market. I mean, we were lucky enough 2 years ago to do an ILS, $120 million ILS, and it was well received. And so I think there's a lot going on right now. Where it's going to go, more consolidation, probably not on the life re side, maybe on the primary side, but I can't imagine, too much more.
Yeah, I think John and Casper have covered most of the things on this. I guess the only other piece is to add a bit. I would lean more towards there being more consolidation in the life primary side. John gave the example of some of the PNC and just other companies who may want to focus on different aspects of their business in ways to make money going forward. And then the one thing that we haven't really talked about yet, and this won't be wholesale sales of companies, but just some of the SIFI designations and things like that. Some of the bigger companies, they're going to somewhat be forced to shed some businesses and move some of it around. The SIFI and the global SIFI type things are very much set up so that you're on that list and you're trying to get off. And that's what the regulators are going to be encouraging, and the way you get off those lists is to shrink or reinsure business elsewhere. So I think that'll provide opportunities as well as just continued consolidation from folks who don't necessarily want to be in some of these businesses going forward. So.
Yeah, and I think, Casper, just picking up on a point you raised, the ILS angle is one that I find incredibly interesting. And it's obviously been a key part of the discussion earlier on the panels on the P&C side. But I think historically a lot of people have looked at the life industry and have thought that the duration of the liabilities that they're trying to get into just doesn't lend itself to being able to get into what is typically a short-term horizon for investors on the ILS products. Mm-hmm. I think, as you said, you had a launch which was particularly well taken up, and we were very happy with it. So what's your view of the likelihood of seeing more of those in the future?
Well, I think one of the issues with our ILS was, it's like 6, 7, 8 year duration, and for many people in the market, that's pretty long. I think you've seen a few other products come to market, one of the cat mortality bonds, possibly shorter durations. I think that might attract something. I hope that more money comes into the sector and that primary and reinsurance firms do put that type of bonds out there. I think that will happen in time. I think it will be slow. I think you need sophisticated investors who understand the risks, who are in for longer term investments. But is it going to look like the property cat side? No, not for a long time.
Yeah.
I think you have duration and you also have correlation.
Yeah.
So that's the other factor. People looking at ILS as a non-correlated return, but I have to agree, and someone else in the other panel said that, how well is that understood? Like you can actually have a total loss of, with a big event. So, and well, I would argue that that's, we are very correlated actually to pension plans in particular, equity risk. They firmly understand, annuities, for example. So understanding the risk may trump, and correlation may be your biggest, risk within that type of product. So looking at new structures, how do you design new structures, looking at third-party capital, what's the efficiency of deploying that capital, and the cost of that capital. A lot of that's being driven by the cost of capital. So we look at that carefully, and investors are also scrutinizing that as well. And I think you'll see a combination between, cat bonds on one end and hedge fund reinsurers on the other. There's a lot of room in the middle for creativity and innovation that Bermuda is promoting, and that I think you're going to see quite a bit more activity, within the middle range of those two bookends.
And I would just add, as far as ILS for the life side, it's almost got nowhere to go but up. There was some deals done pre-crisis, XXX, AXXX, either through an auction rate market that then fell apart, or just through having monolines wrap them and just simple basis trades, and that's gone away. It almost comes back to your comment earlier, Colin, as far as marketing. I think the industry would need to do a better job marketing what these things are, marketing how the mortality or longevity or what have you works. And I think the duration is something that can be overcome. Pension plans are looking for duration, and just society will be looking for duration as they enter retirement. So getting something that's 7 or 8 year duration, or even maybe a bit longer, shouldn't be the impediment to some of these markets. But I just think it was developing in the life side. Financial crisis hit. At the time, I was actually treasurer within Aegon in the Americas. We were trying to develop some more public deals. We've got one out there, and that's all sort of ground to a halt, and hopefully we'll come back here soon. But there's lots of potential there, and I think the industry needs to keep working on that as another alternative source of financing of capital. So.
Yeah.
I think actually, just to add to what Craig said, the other, while correlated, there also is very low volatility to this exposure on the life side. Yep. So that's very attractive. And so if you can get, longer term yields, low volatility, things that pension funds are really, and all sorts of folks are, very interested in. I think the other place where you might see this emerge is with pension buyouts and things that are, there's been two large ones in the U.S., massive pension buyouts where really trading on the longevity risk, I guess, primarily. And so as you see that filter down again from, I think that was AT&T and Verizon, perhaps, to the Prudential did, but $25 billion of pension liability. So as people buy out, as we get the accounting credit in the U.S. that they're getting in Europe for that, you'll see that market develop. And I think there's really been this kind of pent up demand to establish a longevity ILS market, and there are a few issues out there, but it really hasn't been as robust as it probably will be as, again, retiree ages increase, people retire more en masse, et cetera. So I think that's to be developed.
Yeah. I'm just going to pause there for a moment to see if there are any questions from our audience they'd like our panel to cover. Good. Yeah, one in the front here.
You've seen pressure on life reinsurance ceding rates, particularly in developed markets, over the last, for a while now, really. Do you feel like with SIFI and some of the other things that are going on that those pressures have maybe bottomed?
You mentioned SIFI.
I mentioned SIFI, though, as a generality. I'm not actually a third-party reinsurer, so we sold ours.
Yeah, have they bottomed out? Hope so. When we look around the world, when we look around the world at reinsurance and retro, and we hope reinsurance rates or ceding rates have bottomed out. That in Canada, they're quite high. In the U.S., they were high and they were going down. But I think we see that growing over time. That's our view. And one of the headwinds against that, though, one of the arguments against that is, though, we are seeing a lot of primary guys actually taking a lot more risk on their balance sheet. And one of the reasons why, for instance, they can take life risk is because they are looking at the longevity risk and saying, geez, maybe we can balance this out. Maybe what is an optimal way as a primary guy? How much should we hold on our balance sheet in terms of mortality or longevity, and how much should we take out to the life re or longevity market? So I think right now there's a lot of discussion going on in the primaries, thinking about exactly what optimal balance is. We think there's growth there, but there are certainly discussions going on.
We're not in the life reinsurance market per se, but I would just say with consolidation, really in the U.S., that's a pretty broad question, but focusing on the U.S., you really just have a certain amount of folks that are in that market, and a lot of them, like RGA, for example, really focus globally on growing their business. So I think with consolidation, you may have less commoditization of pricing. So possibly that's is a bright line for those. But I also agree with Casper that internally, people looking at longevity as a hedge, for mortality. So as people work through those issues with sophisticated, partners and consultants and staff, you'll see probably more of that developed. And then but I still think, that being said, you'll still see an opening of an ILS market as they sort through how to transfer that risk the most effectively and economically.
Just picking up on that point on the longevity market, I guess it's one that we've seen historically or viewed to be fairly mature in a European environment, but kind of not entirely greenfield, but certainly underdeveloped in US and Canada. How do you see that developing now? Is it an area of real potential growth for the reinsurance side, or is it just going to continue to be this disconnect between the European model and the North American model? No,
Yeah, sorry, as a reformed pension actuary, I'll take that. Europe, you've seen it for years. You've seen it, out of the UK because of a number of factors, including, just the way that how pensions were annuitized. In the Americas, you're seeing a couple of headline stories: GM, Verizon, even Ford, and some really big deals. I think. And when you look at the defined benefit market in the Americas, I mean, it's many, many billions. And so a logical conclusion is that the longevity market will develop. And I think it is developing. I think it will develop. But I'll take a slightly different view than many of the pundits. I think it's going to develop slowly. And the reason why it's going to develop slowly is because of the solvency and funded rates right now are below par, below 100. I mean, recent equity markets are going to help that. But we're still going to see a lot of DB pension plans underwater, and they're really not going to look towards longevity swap, buy-ins or buyouts or swaps until they get closer to parity. And also from a regulatory perspective, that there's not a lot of push to, in my mind, to get to price longevity on the pension plans right now. There's a lot of research, there's a lot of debate in the actuarial realms. Looking at new longevity scales, scale BB out of the U.S., and until those work their way through into the valuations, till they hit the balance sheets, that's when you're going to start seeing the pricing you'll see in the reinsurance market to match what they're holding on the books. That's when I think we're going to see the market really turn. So I think we're going to see some over the next little while, but there's going to be an inflection point coming up, and that's when it's just way too painful on the corporate balance sheets.
Yeah. If I could just have one final question for the panel then, and appropriately broad-ranging. We've seen the nascent involvement of new entrants and the third capital providers that we talked about in the industry already, and brings with it the diversity investment strategies and also a lot of attention from the media and the regulators. So as a closing view, and maybe looking in the 5 to 10 year horizon as we look to the future, what do you see as the impact to the industry of these new sources of capital coming in, and the return expectations that are going to come with it, and whether or not we're going to see changes in the competitive landscape as a result? John, if you could.
Well, I think we probably have 3 different perspectives on that question. I think I see it growing. I think that from our standpoint of the asset-intensive business, there's, on the DB side is trillions, which are underfunded, by the way, of course, and but I think that what you'll see is, and I think you need more efficient, you need more yield in these portfolios. So that calls for more, possibly, I won't say more aggressive, but more alternative assets in those portfolios. And then you need the managers that are effective in managing alternative assets. So when you get the BlackRocks and the Blackstones and other large firms that are taking an interest, Berkshire Hathaway on the other side of the house, it's a permanent force, and it's going to be. We're already living within it right now. The size of the M&A market in the U.S., which is, I won't say it's gone unnoticed. All of us on the life side are very well familiar with it, but it hasn't garnered a lot of attention other than, some of the noise out of New York. But so I think it's good for the industry. The consolidation is going to be good for the industry. We need. There is some. I think responsibility on the part of the new money coming in to provide more efficient products that will help get people to a better place, for retirement. That sounds somewhat altruistic, but the fact is that most people are 30%, 40% funded. Going from defined benefit to defined contribution plans in the U.S., you immediately underfunded everybody, and you have I think 80 million Americans retiring in the next 10 years. So you're going to see a need for these, and they are also, and financial planners and others are looking at annuities, for example, as part of your retirement plan. So you are going to see the need for more efficient products, and then going back to the 10 or 11 and 12 products now being issued by reinsurance or primary companies connected to reinsurers. I think it actually bodes well for the industry. But it's you really have to thread the needle. With all the regulatory constraints, investment constraints, you can't just rush in and throw up a hedge fund strategy and effectively get into the business. So it is reasonably carefully monitored, and I think but overall I think it's good. It bodes well for the industry.
And I would actually echo a lot of what John said. I think the new entrants are good for the industry. I think they're in some ways better suited to take some of the risks on that they are taking on. And it'll allow the life companies to focus on maybe what they do better, some of the biometric risk and things like that. So I think probably look back in 5 years and wonder what all the kerfuffle was about as these companies do well, perform well, and have probably a few more new entrants into that market. And I think it's good for the industry overall. So.
Yeah, and I would say I'll echo that and actually reinforce something you said about, I think the industry and life reinsurance industry in particular, I think we can do a better job marketing ourselves, explaining ourselves about things like spread business or biometric risks and long tail. And I think there is capital that will enter the market, and I think that's good. But I also think that, I think we've got to reinforce the value proposition for many of the companies aren't necessarily clearly demonstrated through traditional accounting methods, and we have to talk about embedded value and what the heck's that, and keep people comfortable. It's all about marketing. It's all about explaining. I think that's when you'll see more capital moving in, because under traditional accounting methods and long tail, that the profits really don't come out till many years later. They don't come out until the tail. And so it's really hard to buy things that really don't show good, economic basis accounting basis to start, but from an embedded value perspective are pretty good buys.
So I think the key takeaway I'm hearing is the industry needs a better story. I'd like if you could join me in thanking our panelists for their contribution. That was a very good discussion.